In the simplest terms, interest rates can be thought of as the price of money. So the way most people will interact with interest rates is when they get a loan of any sort, the interest rate will be the interest that they pay on that loan, but it'll also be the interest that you'll get back on savings if you have money in the bank, and that's called the deposit rate. So you can get it both ways. The Reserve Bank of Australia set interest rates in Australia through what's called the cash rate target. At its simplest term, it's really the cost or the interest rate that the banks have to pay each other to move money around, and that really anchors interest rates all across the rest of the economy. When the cash rate is moved up, for example, it means that you'll pay more for your mortgage or more for your car loan, for example, but it also means that people who have money in the bank or savers will actually get a bigger return on their savings. So it impacts people in different ways, depending if you're a saver or you're a borrower. The main reason they change interest rates is to try and keep inflation within the 2 to 3% target. And the way they do this is when the economy is too strong or the economy is growing too quickly, for example, that could trigger higher inflation. The RBA might increase the interest rate in that circumstance, and that'll slow the economy down to bring inflation down, and vice versa. If inflation is too low, they might lower the cash rate to stimulate more spending, more investment from households and from businesses to try and get the economy going and inflation to the target. The cash rate is an incredibly important number. It is often called a blunt instrument from the RBA. They only really have one lever to pull to influence the economy, but because it has such a wide-ranging impacts across governments, businesses, and households, it really is the most important number that you can look at when thinking about what the RBA is doing.